When can we see a bounce back from the bear markets in both the stock markets and the gold markets? Well, we're here to discuss this with Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com. Chris is an accomplished technical trader, and he is here to discuss with us how to trade the current market and his outlook for these markets. Chris, welcome back to the show. Always great to have you on Kitco.
Great to be here. Thanks for having me, David.
Let's start with the stock markets first. Now, medium-term outlook and then long-term outlook. So medium-term, I'm looking at the last 10 months or so basically year to date, and it doesn't look like the stock markets have ended their bear flag yet. Am I correct to say that? How would you interpret this current price pattern?
Yeah, so if we were to look at our charts, I like to look at the charts from a couple different perspectives. So I like to break the charts down to show visually what they're doing. Green is bullish, red is bearish. And we had a sell signal in the stock market. This was back in February and March to get out of long-term positions for equities. And really, this is a kind of a passive strategy. You just don't want to be holding equities. Naturally, they're going to be going lower. And when we look at a shorter term strategy during that time, you'll notice the last big sell-offs here have been a lot of red to the downside. There's more red than green. And that's what happens when you're in a bearish environment. If you look back here during bull market phase on the top chart, you'll notice when we've got nice strong trending on the daily chart down below, beautiful long trends, lots of money can be made. And so right now we're on a sell signal for the stock market. It is still a bearish play at this point. But what's interesting is we're actually potentially 1 or 2 days away from a buy signal in the stock market to actually get back in for a holiday rally, which you and I can touch on with the seasonality in a little bit here, because it is in favor for pretty much most commodities and equities here to start a rally going forward. So I'm bearish on it long term, but short term, we're actually looking ready, primed and ready for a rally.
I do want to talk about the seasonality aspect, but first I want to not delay talking about your main thesis here, which is that the stock markets could potentially see a decade-long bear market similar to what we saw post-2000 after the dot-com bust. Can you elaborate on that a little more?
Sure. Yeah. So I've been thinking about this for quite a while, that the scenario that we've had in the equities market has been very extreme. A hedge fund manager came out on Market Watch and he kind of said what I was thinking, which is he thinks there's going to be a decade-long bear market in equities. It's maybe not a decade-long bear market, but we could have a very long time before the market recovers and gets back to where we are. So let's just take a look at this scenario, because all this wraps into where I think we are in the commodity, the gold space as well. So if we go back over here this is the NASDAQ. So we had the big tech bubble. It topped out over here. And then we had a multi-year bear market, which I think we could have a 2-3 year bear market, which is what happened here. And then it was dormant for a long time. And it actually took 17 years to break out again and get that money back. So that is a very long scenario. And we've had a huge blow off phase, all kinds of manipulation going on. We've had this first big sell-off on the NASDAQ chart and really on all indexes. But what's interesting is, if we take a look over here, there was this little pause, this bear flag move where it kind of traded sideways and higher. And that's a complacency type of move. And we had the initial big sell-off in the NASDAQ, which is where we are now. This is the initial big sell-off. And I think we could go into a sideways rally into the end of the year. And as the market kind of rebounds, and then eventually I think we're going to start a much bigger market correction that could take a lot longer. And the scenario that we had back over here back in 2000, this was a scenario very similar to if we look at the valuation of stocks and commodities. Here's the 2000 level where commodities were one of the most undervalued they had been compared to the stock market. And here we are now. We've been in that scenario and we're even more extreme than 2000s. Commodities are way oversold. Everybody's piled into stocks and real estate. And when everybody's gone in one direction, usually, it leads to a pretty bad ending because the timing is usually off. So I think we're coming into a scenario very similar that we could have a big unwinding event that takes a few years in stocks. And I think it actually could be very bullish for commodities. Obviously, if there's going to be selling in the stock market, there will be some downward pressure on commodities. But I do think we're coming into that scenario where precious metals could have a very big move, just like we saw back in 2001, where gold put in a major bottom, the dollar put in a major top. The dollar is right back at those lofty levels where there's a lot of room for that dollar to fall, which just gives tons of leeway and headway for gold and silver and miners to rally going forward. So that's a big scenario that people need to pay attention to. And you and I were just talking before we got on here about the SP 500 in the scenario that's here. And of course, it took 12 years to recover, which isn't quite as much as 17. But either way, if you're near retirement or in retirement, you do not want to be withdrawing retirement funds.
Yeah, well, it recovered to its 2000 peak by 2007, and then it crashed again, of course, after 2008. I just want to touch on something you said real quick before we move on. You said that there was a lot of manipulation going on near the bull rally. You were talking about the NASDAQ. What were you referring to?
I'm just referring to the Fed just literally printing off money and creating plans to just drive the markets higher. To me, that's manipulation.
Okay. I see.
But whatever Well,
we had a lot of that. We had a lot of that in 2020, 2 years ago. Is that the main reason we had a V-shaped recovery? Because keep in mind, we had a huge flash crash. Technically not a flash crash, but a very significant downward correction in a very short amount of time right after COVID hit. But then it rebounded real quick. Right?
Yeah, I think that was it. I think they just started creating the printing, pressing, put things in place to give everybody comfort, and they really just saved the day. But the COVID was still kind of a news-driven event, and news can move the market, but it's usually very short-lived. And I talk about this all the time with subscribers. Even when the Fed comes out and you get a big 2.5% or 3% rally that day, and everybody's bullish, I'm like, guys, this is a news-driven event. It's emotions. It's probably going to be wiped out in a bar or two. If it takes a bar to go straight up, it can come right back down. And that's what we see over and over again. And COVID to me was in a way just like that. And they just threw a lot of coal in the fire to keep it, stoked and going there.
Okay. I do want to ask you about the similarities between this current cycle and the past bull markets. Can you pull up that chart again where you drew the percentage declines? So as you've rightly pointed out, Chris, the last two bear cycles, bear markets, the S&P 500 have seen corrections of more than 50% each. In 2000, it was 51%, and in 2008, it was 58%. We're not there yet. I mean, currently we're down about 25% from its highs, but we haven't reached the same magnitude. 27. We haven't reached the same magnitude of decline as we've seen in the previous bull cycles. So, bear cycles rather. So, my question, two-part question: do you think will reach that level? In other words, do you think the equity markets will continue to decline up to 50% down from its highs? And if so, why do you think this pattern will repeat that of 2001?
Yeah, I mean, I hope it doesn't go down there, because it's not going to be the most exhilarating and fun experience for most people. But I think there is a very good chance it could go down there. And depending on how this market unfolds, just if we go sideways here for a little bit, it's going to create a bearish pattern that we'll be able to measure where that downside move is. And, usually you come back to a major support level. And when you look at this chart, I mean, right through the heart of this, I mean, maybe we don't go quite 50%. Maybe we come back down somewhere into the middle, but we're still talking a fairly significant decline from where we are. And I think there's just a lot of unwinding. There was a lot of printing, a lot of things put in place to drive this higher. It created a feeding frenzy of tens of millions of new traders and investors that just drove prices higher in 2020 and early 2021. And I think it's got overexhausted to the upside, and it's going to unwind. And from a technical standpoint, I mean, I see this coming back down in due time, and it could take a couple of years, but it could very easily come down here.
Let me ask you this then, Chris. Suppose we don't see further declines in the stock market. Suppose this is the bottom. Do you think at these current levels, the stock markets can still stagnate for 10 plus years? In other words, do we need to see further declines to a point where it becomes a 50% correction from its highs before the stock markets stagnate for 10 years? Can we just pause right now?
For sure. I think it could pause. It could trade sideways for a long time. And that's fine. That's perfectly fine. I mean, it'll be interesting to see what it does in the end, but it does not need to fall 50% by any means. It could have put a bottom in already, and then we trade sideways in a big choppy range for a year or two or longer. Who knows? But I don't feel like the market has actually shaken everybody to their core yet. We're not even close. I mean, people are starting to get nervous. I'm seeing financial advisors right now posting on their blogs saying, listen, we're getting active. You're going to see some trading. We're rebalancing. A lot of this just happened last week and the week before, but I think investors are really starting to panic because the 60-40, the average portfolio or the retiree who owns a lot more bonds are just getting annihilated. And they hit that breaking point last week. Bonds really went into a waterfall sell-off, and everyone's just panicking out of bonds and dumping them. And that leads us into a point where everything is oversold on a short-term basis. It's also seasonality, perfect timing for the market to find a bottom because everybody just literally freaked out last week and dumped stocks and more so bonds. And now they look like they're ready for like that Santa, holiday rally.
Yeah, more like a Christmas tree downwards. Not really the pattern you want to see this Christmas. Christmas tree up maybe, but a Christmas tree down. That's not
it usually dies and falls at the end of Christmas.
We don't want to draw the second half of the tree, Chris. Right. Okay, Chris, you're right. Everybody was dumping their assets. Where were they going then? It's just sidelining into cash?
Yeah, I mean, we're seeing records amount of cash being put on hand. I think we're seeing same levels of cash on hand as we did like near the 2009 stock market bottom. But we're nowhere near where we were in terms of bearishness in terms of back in 2000. There's still a long ways to go. So even though we've hit levels of the last bear market, I still think cash is going to keep stockpiling. I mean, Ray Dalio always said cash was trash. And, now he's talking about cash is a good position. He's raising tons of cash. I mean, the all-weather portfolio that holds a ton of bonds. I mean, bonds, it doesn't matter what country the bonds are in. Just, when the tide's going down, they're all falling. So, it's cash. Doesn't seem like a position.
I don't know if he's, I haven't spoken to Ray Dalio myself, but I don't know if he's really fundamentally changed his philosophy. Cash is trash in the sense that as a long-term play, you don't want to be allocated too heavily into cash. You want to be deployed somewhere, but I guess what he means 100%. Is maybe currently right now on a short to medium-term basis, you have no other choice.
Yeah. I love everything that Ray Dalio does. I love all of his videos, his insight, his philosophy, his all that stuff. I think it's great. And I believe that cash is trash if other things are going up. Cash is only good when, all the stuff's hitting the fan and falling and there's nothing really to go to. Just sitting in cash is a perfect trade to avoid all that chaos. And that's all I do. I only use it when nothing's a buy signal and everything's falling, we move to cash. And then when the markets turn around, we pile back into the hottest sectors or get into whatever it is that's moving. Could be the dollar. Our recent play has been the dollar. It's been a big mover all year. It's one of the strongest assets, the strongest trends to the upside still. So you just need to be able to be nimble and cash is a short-term temporary protective position.
Yeah, I think you hit the nail on the head there. Short-term temporary. You don't want to be long-term allocated into cash. Correct. Because inflation is very high. You're going to lose value just from inflation. Yeah,
but it's better the whole inflation thing is a whole nother story that still frustrates me because people are like, well, I don't want to sit in cash. I'm going to get eaten by inflation. I'm like, okay, so you want to go in bonds and stocks and lose 20 or 30%, or you want to pay an extra, $40 a week on groceries and worry about that. I'm like, focus on protecting your wealth, not trying to save, on the inflation on just the stuff you're consuming every day.
The upside to inflation, I guess, is that with rates going up, the yields in your savings accounts in theory should also be going up. Banks will be paying a slightly higher yield, not by much. But the real yield, adjusted for inflation, I guess, is still negative. If the real yield were positive, I would say, by all means, stockpile cash, put it in your bank. Or,
the inflation's tough, but the key is, do you want to if you're worried about inflation, I think you should be more worried about your nest egg, which is most likely a lot of money, losing another 5, 10, 20, plus percent in a short period of window when you could just sidestep it for a few months and avoid a lot of that, right? So I'm not too worried about paying more over the next year on consumables and versus I don't want to lose 15 or 25% of my retirement nest egg. It's going to be a lot more than me trying to preserve the inflation side that's costing us. It's just, there's no way around it. I mean, you got to pick one or the other. And right now, to me, the investments aren't the place to dump your cash. Long term, I think it needs to be very defensive here.
I looked at some data published by, I think, Bloomberg, and it was very interesting. Historically, the equity markets would trough at a different time than the actual economic trough. So in other words, let's say GDP goes down and we get a contraction in GDP, which we have. The equity markets typically in the past have rebounded shortly afterwards. In other words, the equity markets were a leading indicator for economic rebound. And so you don't actually want to wait for the economy to recover because by that time you would have missed out on double-digit gains, according to this research. Is this something that you've observed?
Yeah, for sure. So here's a simple cycle. So the blue cycle here is the stock market. So it bottoms well before the yellow cycle, which is the economy. So the stock market is forward looking. And so it'll bottom first and you want to follow it up. And when the stock market bottoms, it's going to be bad news, layoffs. It's going to be terrible. Same with the stock market. I feel as though it's topped. I think we're somewhere in early bear market phase. The economy's, it hasn't fully died yet. It's still actually pretty good. But by the time the economy catches up and says, hey, okay, we're in a full-on recession, things are ugly, we're already going to be well into a bear market that we saw, literally in February of March of this year. So it could be a year ahead of the stock market. So stock market or the economy. So stock market is always leading. It'll top and bottom before the economy. And you don't want to wait for the economy, wait for the news to shift because the news is very, very delayed.
You said the economy is actually doing pretty good right now. What indicators suggest that the economy?
Well, I mean, I wouldn't say it's doing very good. I feel like we're in a recession, but I don't know if we're technically in a full-on recession just yet. But I think it hasn't come out like mainstream full-on recession. This is it. Like that hasn't come out yet. I think we're in a recession, but the news hasn't caught up yet.
You're right. Okay, so that was an excellent chart, Chris. Can we go back to that chart? Just want to point something out.
Sure.
So the reason I brought this up is I wanted to ask you, in relation to this chart, what should the investor's mentality be right now? Is it to position yourself for a recession that's imminent, or is it to position yourself for an imminent rebound? Because if I'm thinking that, okay, the economy has already entered a recession, it's time to reallocate capital back into risk assets, my mindset is different from somebody thinking, I got to be defensive, I got to protect my capital, there's more downside coming in the economy. Where do you stand?
Yeah, so I'm not one, just because something's selling off and is down a lot, I'm not looking to buy it. I'll be waiting for things to bottom and for the uptick. I want to see price starting to rally again before I get in. So, I mean, a good scenario of this is if I just pull this up really quick here. So I did a real estate article talking about where I think we are, but let me just skip down to this kind of view of, the stages. This is the same stage for stock market and everything. I think we're on the verge of breaking down in real estate market and also in the stock market. And we're kind of here in terms of this cycle chart. So up here means any investment you buy way up here, you've got peak, you've got maximum financial risk. You're paying a premium for real estate, you're paying a premium for stocks, all of that stuff. We need the market to have a contraction. It needs to find a bottom, and then it needs to start to turn up and give us that uptick. And we're a long ways from that, but we really need to wait as an investor to deploy all of that new capital. And I'm not waiting for something to drop down a fixed amount of percentage points. I'm waiting for it to drop, bottom, start to head higher, and for all the technicals and everything to line up saying, listen, this looks like it's the real deal. Let's get in. And so I'm waiting for this cycle to bottom and start to turn up. I'm not just jumping in. I know a lot of people are piling into the stock market right now thinking this is it. It's the bottom. I still think we're far from it, and you got to be very patient. Investing trends like this, these take months and years to unfold. So it's going to definitely take patience, but a lot of people just don't have the patience. They want to be active, and that's the problem. You get sucked into short-term plays. I think we're going to get a holiday rally. It's going to suck a lot of people in, but if they don't protect their positions, if the market starts to roll over come the end of the year or January, February, it might roll over and might not come back for, 5-10 years for all we know. So you have to make sure you take profits, that you manage your positions and risks, take, raise your stops, all those things. There's a lot of work to be done. People who are very passive investors who are just biting the bullet and they're riding the roller coaster. If you don't do any work, you're going to ride the roller coaster. You're going to underperform in the long run. If you see any experts, overachievers, they work hard. And that's what I focus on. We manage our money. We make sure we're in when it's good. We're out when it's bad. We look for new opportunities. We are kind of like an athlete when it comes to the stock market. We're constantly protecting. We're constantly looking for plays, managing the positions, working our money versus just being passive and being like, okay, whatever happens, happens. I'll just ride this one out, right? We don't want to do that. So
you do have to. I just want to touch on real estate real quick. The passive mentality is one of many real estate investors, because you can't. I mean, real estate is not a very liquid market. You can't just trade it in and out of your house. Just going back to your real estate article. Can you summarize your findings for us? Do you think that the real estate market, or markets in North America, will also stagnate for the next 10 years like the stock markets would?
I do. I think they've had a huge blow off phase. There's a guy who just talked about, what's his name? Christopher Whalen's talking about 10+% mortgage rates next year. It's just like the bond market. If yields go up, bonds go down. Well, if mortgage rates go up, home prices come down. And he's talking about all of the COVID gains in real estate being wiped out, which is what I've been talking about for months. I talked about in February. I think we're more at risk almost in Canada and in the UK because our average mortgages here are 3 and 5 years when they come up for renewal. In the States, people can lock in a mortgage, that rate. So the low rates that they have now for 30 years, but we have to renew in 3 to 5 years. And if we go from a 2% mortgage and then in a couple of years have to renew at 10%, you're going to go from, a $3,000 mortgage to a $10,000 mortgage. And most people are going to be like, I can't do it. And there's going to create all kinds of, housing just flooding the market. People aren't going to be able to get the financing their mortgages because there's no way their income is going to be able to protect them or cover them for that big of a mortgage payment. So I think we're in for some pretty tough times, which I think is an incredible opportunity for investors who are sitting in cash, who are raising capital, who are protecting their money and waiting for that bottom in this cycle. And real estate's very delayed. I mean, when we saw the 2008 market bottom, I mean, real estate still took a few more years to bottom. And that's because there's a 2, 3, 5 year delay in mortgages and people renewing and then not being able to get financing, not being able to pay for it. And so I think real estate is going to be a little lagged, like it kind of almost always is from the stock market. And it's going to be a great opportunity, but there's going to be a lot of pain when mortgages come up for renewal for a lot of people. And it's just the real estate's not going to be a good investment if you're paying 10% on a mortgage. An investor is going to be like, well, I can't get a renter to cover the cost of 10%. You got to drop your home value, huge. There's a house just down here that just was at $3.5 million. They just dropped it $500,000 last week. I mean, it's a huge drop. That's a one clump. So real estate is, it's on a downward spiral. And as mortgage rates keep going up, it's going to just keep applying more pressure. And then just time is going to cost the real estate market more because people will come up for renewals. They're going to be forced to sell because they can't carry the cost with their current jobs and income. And if we get into a recession, there's going to be layoffs. There's going to be wage cuts. It just all compounds, right? So this is going to be an opportunity for people who aren't in the home market to be able to get in and get one, I think, at a fair price down the road. It's going to be great for investors to pick up extra rental properties and have your kind of pick of the litter. So I'm a huge real estate investor. I've got over 75 tenants myself. So I love real estate. It's a long-term play, but I do not buy in bubbles.
What are you doing with your properties right now? Are you selling?
No, God, no, no. I mean, I bought them long ago. They're just retirement, just regular monthly income, right? I paid pennies for them for what they're worth now, and so you just let them run, just manage them. I'm not looking to scalp or trade real estate. I'm looking to buy after recessions, build beautiful properties.
So you're not concerned that this dip is going to affect your, I guess, equity value on paper for now.
I'm not worried about the paper value. These are like your retirement ticket. It's cash for life. Once you've got beautiful properties and they're rented out, I mean, it's income for the rest of your life. So you just build enough that you can do whatever you want, and money's not an issue. And you've got these nest eggs that over 20, 30 years are just going to keep going up. But if you're like an investor who's always strapped and you're overextended and you're buying properties that, if a renter isn't in there, you're going to actually not going to be able to make the payment. That's a different story. I don't buy stuff leveraged. I don't extend myself. I just pick up, investments that are feasible, that if I didn't get a tenant in it for a year, it really doesn't matter. All the other properties carry, for everything else. So I'm a very conservative investor. It takes me a long time to do stuff because I don't borrow a ton of money. I usually just use my own capital, reinvest it. So I never get overextended, and I can ride out any bear market without a real hitch at all. I'm not concerned.
One more question on this, and we'll move on to gold and finish up there. So your point about mortgage rates potentially going up to 10%. That is scary. Do you think, though, the Federal Reserve would allow rates to, I mean, we're not talking about mortgage rates. The Fed doesn't control mortgage rates, but the Fed funds rate, there is talk of a pivot by next year, by spring, because they know that a recession could be worsened if they continue raising rates. And they don't really want that. As much as they want to combat inflation, they don't really want to kill the economy either. They don't want to create a Lehman-style event. Potentially we could see 10% mortgage rates, but how long would it stay up there is my question.
Yeah, it might be fairly short-lived. I for sure feel like the Fed will step in. They're going to hit a breaking point at some point here, and they're going to be like, oh my gosh, we have to do something, right? The bond market has probably got so much pressure on those guys because that's where so much capital is tied up in the huge losses. And so they're going to do something. The question is, it might not stay up by 10, but maybe it's going to stay at 7, 8 for a long time. I mean, that's still a huge mortgage rate for most people. Like people got, that's still 2-3 times depending on where you're at.
So I guess if you're a new home owner and you're looking to get into the market, should you be looking into a variable or a fixed, given what we just discussed? Because, a fixed rate could guarantee you a very high rate, but a steady outflow of cash. But you could be betting on a variable in the sense that the Fed might be reducing rates sometime down the line.
It's a tough call. It really depends on your financial situation. Depends if it's your second, third home, your first home, both family members working. I mean, it comes down to, and your risk level. Do you want to gamble it and ride the fluctuating rate, or do you want to lock it in? It's a really individual specific call. And I think rates are going to spike, but like you said, I don't think they're going to stay up really high for a long time, but they're going to create a blip on the real estate chart. So I'm not sure what the best play is, to be honest. This is a tough time when I'm not looking to buy real estate for these reasons. It's a crapshoot.
All right. Well, when the market does bottom, when you see a signal in either the stocks or the real estate markets, let us know down the line. We'll have you out. Yeah. We'll have you back on before then, of course, but that would be an important signal to follow. Let's move on to gold now. Another commodity or asset that's been running downhill for the better half of the year. Ever since August, I'm looking at the charts. It seems to me, again, gold's been in a bear flag pattern. Am I correct to say that?
Yep.
And I mean, no signs of breaking this pattern anytime soon, Chris?
Well, the monthly chart, this is the monthly chart of gold, and we actually broke down last month on the monthly chart for gold. It's not a good thing, and we're continuing to stay under this level, which is, we'll see where we close out October, but 2 closes below this blue line, this major support level around 1675 is a really, really important level. And the last time we broke something like this, the market completely unwound and it sold off in a big way. And I think there is a lot of potential. You can take this double top, the volatility between the high and the low, you can just do a really simple breakdown of where it could go. And that brings us right down. It's a pretty big pullback in gold somewhere through into this area. So there is a very good chance that gold could still kind of flush out and have some weakness to the downside. I think if the stock market does sell off, I think we're going to see gold probably pull back, potentially test these levels. I think it's going to be a good long-term opportunity down there, but overall, gold right now has been out of favor. It's still out of favor, and right now it is broken down. So I'm not looking for really any huge move in gold. I think maybe it could have an end-of-year rally, but I don't think it's going to be anything very big. If anything, it might rally up to 1,800, which would spur a big rally, I think, in miners. I think miners are primed and ready to be one of the best sectors. If we get a buy signal in the next week or so for our indexes, I think we're going to see GDX, SILJ, all those take off and post some pretty big runs. But again, it's going to be a trade, not like, get in and hold forever. Because I think, as we were talking about, I think the Christmas tree is going to fall. It's more of an end of year trade, not a buy and hold gift.
we just want half the tree, not the second half. Yeah, what a terrible Christmas this is going to be for traders if that continues. Okay, so all right, but you're telling me offline gold miners might be a potentially excellent trade or play. How does that? I'm curious to understand your rationale here. If you think the equity side, the equity markets are going to see more downside, wouldn't that drag all equities down, including the gold miners?
Well, here's what I think is going to happen. So if we were to look at the market seasonality wise, gold usually puts in a bottom in October, beginning in November, October. So we're right there at this point. I think we could see. Let me just zoom in a little bit here. Let me go to the daily chart because we're talking short-term trade here. If we look at the chart of gold, I think we could see gold potentially rally up, work itself up to potentially this 1,800 level. And during that rally, gold miners are leverage play. They move, even though this might not be a very big percentage move, if we look at it, that's, an 8% rally. That could be a 30+% move in the GDX or SILJ, or could even be more than that. So I think there's a lot of potential in the leveraged gold plays, and gold and silver don't need to move far for those assets to rally. And we've already been seeing quite a bit that the energy sector and the precious metal miners have been kind of the strongest sectors. Whenever there's not panic selling in the stock market, we tend to see them move higher while the stock market is kind of still selling down. But it's not like fear is driving the markets down. It's the fear that pulls everything down. But when there is no fear, we're seeing gold miners lift up and hold their value really well. Believe it or not, they're top of our ban list along with energy sector. And so it's not going to take much that if they rally a little bit more here and we get a buy signal, they're going to be, top of our list to say, hey, get into GDX or GDXJ or SILJ is the strongest one at this point, and it could have a very big move. So again, this would just be a rally into the end of the year, and then we got to just take it by stride, manage our positions, because if it rolls over, you don't want to be giving back those gains. So it's just going to be that type of a trade. That's it.
All right, Chris, let's end today's episode here. That was a great talk. So bottom line, short-term rally in gold coming up, but over the long term, you're bearish on risk assets. I wouldn't, normally you wouldn't characterize real estate as being a risk asset, but you're also not super optimistic about that market either. So we'll follow up on that. All right,
Sounds great.
All right, and thank you for watching Kitco News. I'm David Lin. Stay tuned for more.